Another episode of Fun Friday with a recurring guest, a familiar face if you know the company, if you study the pitch decks, if you check the website out. All around great guy. One would argue the pride of Menlo Park and certainly of Sharon Heights. Brad Oliver, our director of acquisitions, is coming back as a recurring guest here. We are hydrated. We're fired up to talk to everyone today about what we're seeing in the marketplace. And I think it's so important to really have Brad on here as much as possible. And the reason why I say that is we have our investors listening here. We've got our fund managers on this kind of platform listening. We've got other people that are kind of ancillary people to the business. Maybe they're a broker, this, that. I'm always surprised by who is listening to the show, frankly, and the reach we have. So thank you so much for listening. But with Brad here, Brad is the one who is going through the painstaking process of connecting with brokers, going through that, making sure that we find the needle in the haystack, underwriting hundreds of deals to only buy one, bidding on tons, not getting there. We'll talk about the bid-ask spread. We'll talk about what's going on in the marketplace. But it's so important to have on Bradley Oliver, a director of acquisitions. How are you today?
I'm doing great, Craig. Thanks for the introduction. The saying the pride of Menlo Park is a high honor. When I'm on the pod with you right now, we've
Right,
got
right.
you, Rob, Dasha. That's a high honor. So I don't know about
Yes.
that one, but I'll take it.
Yes, yes. Well, Brad, just real briefly, can you summarize your responsibilities at the firm, just so everyone knows kind of as to why you're the point of authority and the person who I connect with so much and put so much trust into, as are all of our investors who may not be familiar with how the process goes. I think it's maybe not a misconception, and I don't want to understate Rob's importance to the company and to the underwriting, of course, but Rob, of course, wrote this book and then trained up Bradley Oliver here, of course, to be his protege of sorts, the person who's on the acquisition side. So, can you just explain to everyone what you do in the role? I think so many times, as I said, people think that Rob is still in the weeds and underwriting everything, and he obviously does the final say, like he does on my position, your position, and Josh's, and of course, overseeing everything. But just in some words, explain, please. That'd be great.
Well, yeah, happy to touch on that. So my main responsibilities, first off, we've got to find deals to look at. So I spend a lot of my day, talking with brokers, whether I'm reaching out to them or they're reaching out to me with a new opportunity, or we're just discussing the market, what's going on, and really just staying on top of things and just understanding, where deals are trading, what new opportunities may be coming, and staying on top of both marketed and off market opportunities is really important. So yeah, that's really probably the most important thing I do. And then building off of that is underwriting, obviously. So once we have a deal, have the materials, spending a lot of time processing the numbers, looking into each deal, just trying to understand where the deal could make sense for us in terms of pricing, and then obviously working with our debt broker, Nate Lowy, trying to understand what kind of debt we can put on the deal, reaching out to our tax and insurance consultants, understanding where some of those more uncontrollable expenses and things like that are going to shake out. Um, and then beyond that as well, when we have live deals and things like that, help working on the purchase and sale agreements, and then also just ensuring that everything moves from contract to close. There's a lot of, kind of more admin tasks in between there, which are really important to stay on top of, keep everybody moving. Lots of different moving parts once we put a deal under contract and getting that to close. So whether I'm working with you, Craig, on sorting out equity questions, preparing materials for investors, and then also making sure debt's moving along, insurance, what have you. All of that's super important. So it's a very good mix. And then when I'm not in New York, of course, spend a lot of time down in Texas, going to drive and tour deals, get some FaceTime with brokers, which is obviously the more fun part of the job. Always fun to get boots on the ground and really just be able to understand what's going on. So
For
yeah,
sure.
high level that covers most of it.
Yeah, and you and I both know and joke about how great the diet is when we go on these business trips. It's a an S show. We try to not curse on the show here, but it gets bad. We're eating everything from everywhere. You're naturally taking people out, taking those bullets, taking those beers. Making sure the brokers are loving us and they have a good time with us, and we don't, look like those who are square, if you will. So sometimes you got to do the boozing. Similar here, Rob, it made me the designated drinker, so I'm the DD at different sorts. If we're going to meetings and stuff, you gotta bet. Listen, if our people are having glasses of wine, I'm right there going drink for drink with them. It's just not every job requires the same things, I suppose, but someone's got to do it. So we thank you for your service there, because someone like myself really knows the process there better than anyone.
Yeah, yeah, we thank you for your service. It's
Yeah, it's gritty stuff here. People think this white collar works really easy.
exactly. I mean, somebody's gotta handle the few pounds in weight fluctuation week over week when you're down there.
Yeah,
It
and how thick your fingers get, or like you can't really see them. Yes, 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 yes. But let's get into the nitty gritty here. Let's talk about deal flow. You mentioned something on market, off market. We'll get into that, but let's just talk about holistically 2024 and what this year has really offered to this point. And I think by the time we release this show, it's going to be sometime in October. I believe it's October 9th as we're recording today. Sometimes there is a slight delay, so I just want to preface that because obviously the world could change. But let's just set the stage a bit. We've done about 4 deals so far this year. We're looking to lock up our fifth or close our fifth here before the year ends. Puts us about 200 million or maybe a dollar or so shy, maybe 190-ish of acquisitions this year. But where's the market been? What's deal flow been like? What's sentiment? What's talk of the town here?
Yeah, definitely. So, I mean, first and foremost, there's been an enormous amount of volatility, obviously, just in terms of the capital markets over the past year. The beginning of the year, we deal flow was still fairly slow. I think it was probably one of the slowest NMHCs we've had, where it was like, there was kind of optimism that things would pick up in 24, and optimism for brokers, but there weren't really a ton of deals. But at that time, I would say in the beginning, the first half of the year or so, there really were not as many buyers in the market, which I think we also really took advantage of and found some great deals to buy. And it's so it's definitely evolved. There's been a lot more Class A deals trading throughout this year, and especially now as we've now have a rate cut. And so a lot more institutional money is active in the Class A space in core deals. And you know that's not really the kind of product that we are chasing per se. That's not really our niche. That's not what our equity is looking for, not what we are looking for. But those deals, they're less sensitive to volatility and interest rates, and lots of those deals are purchased with very very low leverage, or sometimes even all cash from large institutions. So there's been really the majority of the activity has been in that space, which has been interesting. And we did actually spend some time in the first half of this year tracking some of those deals and bidding on some of those, just because it felt like there was a bit of an opportunity where a lot of those institutional buyers and things were still kind of on the sidelines. We were close on one deal back early in the year, I believe around February, March, which I'm sure you remember, Craig. And it was a really interesting process where it's not usually the type of deal we would be going after or be able to be in play for, but just by nature of us staying active, we had an opportunity. Ultimately, didn't work out, but there's been it's been two ends of the spectrum, where there's either super nice core Class A deals, and there was all this new supply from COVID that's coming out of lease up, and those are owned by the developers. They're not in the business of owning and managing those deals. So those deals have been coming to market, and those have been trading. Those are very liquid assets. And then on the other end of the spectrum, you've had Class C, a lot more junkier deals, if you will, kind of Class C deals, where there's been, a lot more distress where, say, owner bought it wrong during COVID, high leverage bridge loan, same story. I'm sure it's been touched on and beaten to death on this podcast as well. But uh, and those deals have been very challenging to transact, and some of those we've seen not even end up transacting. They may come to market or we'll see them off market, but ultimately they're worth less than the loan amount. And we really just haven't seen lenders being willing to move much and take a discounted payoff on those deals. Um, there have been actually steadily a steady rise in foreclosures as of late, which I think it's obviously not fun for anyone, but I think last time I was on the pod, I got to give myself some kudos. I think I did call that happening. That the music has to stop at some point, and still not a ton of foreclosures, but those deals are have been very challenging to transact on, and frankly not what we really want to buy. And what that comes down to is it's really challenging to pencil value add deals right now, and there's not a whole lot of it that makes sense. Bridge financing has been so expensive, and there hasn't been robust rent growth. You don't just put in a backsplash and get $100 rent pop anymore.
Well,
It
that was a
doesn't
fake
work like
world.
that.
That was fake
Exactly.
world. And we're going to go back to actually
Yeah.
value add plays later. And actually, my philosophy on this, I think those who are really in the business and are seeing it day in and day out are kind of agree that maybe value add's a little bit overrated, but we're going to get into why that is. You're a value add investor. You're not a value add. You're a value add returns investor, which is basically a mid-teen return, maybe a 20 IRR investor. But that's what everyone is, okay? But we're going to get into that later. But you mentioned something. Let's get into this. Foreclosures. I think foreclosures is a very interesting conversation here because so many people have this spitting image of the last kind of crisis that we were in from a financial play, which was the GFC, which all these homes and commercial properties had these foreclosures. So the single family world is not going to have that happen because most people have fixed rate debt. It's not floaters, they're not bridge. People have got tarmacs on these deals. Locking in a 30% or sorry, sub 3% rate at 30 years, that is the best debt nor the best financial instrument. Unfortunately, commercial real estate is not built that way. Commercial real estate is a different beast. It is a different animal. It sizes differently. Very few people were prudent and had the foresight to buy their deals with fixed rate debt in 2021 and 2022, leaving there being a lot of maturities coming up here. So, of course, what people are thinking about is when the foreclosure is going to happen. When are they going to happen? Are they here? There's going to be all these foreclosures and be so much blood in the street. Well, we're seeing some, but not all over the place. I do think Florida, unfortunately, and the Carolinas may actually get really rocked by some because their operating costs are about to get really messed up. What do I mean by that? Your operating costs are your property taxes and your insurances. Well, this hurricane is going to be no for your insurance costs, which is really going to throw off your expense ratio, which is one of the contributing factors right now to foreclosures. It's the expense ratios changing on everyone. So that is basically, your insurance costs and your property taxes. You underwrote it to be here, then it became here. Your rents maybe are staying stagnant, but your costs are now here. Well, now you're kind of underwater on that property. So evaluations have changed. But foreclosures, are they happening? Are they abundant? Are they not abundant? Let's hear your perspective on that from someone who's in the market looking at these deals day in and day out. And if they are abundant, are they good opportunities?
Yeah, so definitely two parts to that question. I would say so there have been some foreclosures, and I would say, across our major three markets we're focused on are Houston, Dallas, and San Antonio. And I would say, interestingly, um, I think San Antonio has had the most foreclosures as of late, and that's been in large part due to, I think, the fundamentals have just the overall market fundamentals have been softest there in relation to DFW and Houston. And so it's really challenging if yes, obviously you've had taxes and insurance spike on you. You have, you know, you have a ton of, very high interest payments to pay on your loan. And then also just the market fundamentals have been soft. A lot of, occupancy really is high 80s for the most part. There are some challenging deals where you've got to offer lots of concessions and things just to get occupancy back up. And so this is all a result of just the kind of mass amount of supply that's come online. And long term supply will, the supply demand imbalance will work back in our favor. And San Antonio will be a strong market in the long term. But, the way we see it there right now is just it's been challenging to pencil some of those deals and actually transact on those because the values have been hit so hard. So to be honest, one, no, they're usually those deals are in rougher locations and there's it's just rougher product. So it's harder for us to transact on those, and the bank is not going to agree to a price where we can transact. So there hasn't been a ton there that we really can move on, but there have been more foreclosures in San Antonio. It feels like Houston has had some foreclosures as well. And then I would say Dallas has had some, not as many. Dallas has been, Dallas is a very, very liquid market. Fundamentals are still strong there and things. Houston, I think it's mostly happening just really in the rougher pockets, um, is where you're seeing the most struggle.
That makes sense. And then, with the properties that, you mentioned that are just not worth going after, that basically means, just for the listeners, so how the way the capital stack is structured, there is equity in it and then there's debt in it. The debt is the biggest piece to the capital stack, right? So what's happening right now is not only is the equity being evaporated, that means at that point, they could sell it, but all the investors lose their money, but it's not foreclosed. Foreclosure is when you can't make the payments and the property is therefore worth less than what the loan amount is for. And that's the problem that a lot of people are experiencing right now. It's not only is the property not salvageable, you can make money. It's no, this property is got to get worked out by the bank. Someone's gonna have to take that loss. Now the bank has to take that loss. That's a lot of the problems right now, unless you're gonna do a loan modification. So there's a lot of that going on right now. You mentioned it's more consolidated to San Antonio. You mentioned Dallas a little bit better, and then Houston's got problems there. And of course, I say we as in Lone Star the firm, and we talk about this, of course, offline. So let's bring it online. Some of those deals come our way. The brokers give us those opportunities, but it doesn't make sense. So even so, we get this, a quote unquote good deal. It still doesn't make sense. And would you say that's due to the location? Was it just due to, hey, yes, when debt and whatnot was sub 3%, these deals were priced here, but with, debt changing, the evaluations get compressed where the deal's not even good enough. Like, how does that even happen? Because people think, oh, foreclosure, good deal, but it's not always so.
Yeah, I think it's a very interesting point you bring up, and we've discussed this as well. But not to name any names or anything, but have seen some deals that we have tracked and we've underwrote and looked at potentially acquiring, and they have been able to find, say, a buyer that'll get them out just above their loan amount. So lender doesn't need to be involved. Lender will get paid off, and the buyer gets in at what feels like a really good basis. And, there's still a good chance they do well on those deals. But it's interesting where, you can go out and market that deal and say, hey, we're buying this deal at the loan amount. It's a great sticker shock, great story for investors. But it's interesting because a lot of times you can still be overpaying right now when you're buying a deal at the loan amount. And that's the really tricky part. And a big reason why that's true is because also if you're buying one of these distressed deals that's potentially, close to foreclosure, um, you're going to have to buy this deal on a bridge loan, which is still very expensive. We've seen bridge financing options, which are ranging right now, haven't looked at a ton of these as of late, but anywhere from 325 to 375 over SOFR. You still have expensive rate cap costs and things. And so it all adds up. And then there's just piled up deferred maintenance and things because usually these operators their cash positions have been stretched thin and they're cutting corners on maintenance. So in order to properly buy these deals and not have uh, any unforeseen complications when you're stepping into the deal, you've got to budget up front to take care of this maintenance and understand that this is not just your regular run of the mill stabilized 2000s deal in a strong location um, with a stable operator. They're letting maintenance go. You're going to come in and have to do a lot more work than you would usually think on takeover. And you're doing usually, if you're budgeting for capex and things up front, a lot of that is usually to take care or to do renovations and things, do work to where you can get paid on that. As we discussed, even in a value add play, say you're going to be spending those capex dollars on interior renovations where you can push rents, but you have to put money into the deal just to essentially get it back to square one and get it back operating to normal. You can't have down units and things, so it's you've got to be cognizant of all those factors right now. So that's really what's made it most challenging in that space.
Can you just explain for those who don't know what a rate cap is? I think we say it and we throw some jargon around, but I think a rate cap is a very topical word as that is a key component to some of the debt instruments out there. So, in simple form, can you maybe explain that, please?
Yeah, definitely. So essentially when, say for example, you're on a bridge loan, which is going to be floating rate, um, you're trading, your rate is going to be based off of SOFR, which is a moving target and constantly adjusted. And the lender will require you to buy a rate cap that essentially caps the amount of interest you will pay. So it's essentially just a derivative that allows you to, in essence, prepay interest up front to mitigate the ongoing risk of, um, say rates. If rates are, you have a rate cap that holds you at 575 rate. If your all-in rate were to float up to, say, you know 625, you're still only paying a 575 rate on your hold. You obviously can pay less than that if SOFR comes down and your all-in rate is below, say, that 575 target. um, but it's essentially, it's expensive because you are we think of it as you're prepaying interest, because to have that protection you have to pay for it up front. um, and so that ultimately just feeds into the total capitalization of the deal. But right now, especially as rates have been especially volatile, cap costs have gone up tremendously. Well, they actually have come down as of late, but now we're looking at about the treasury's at about 4%. So things are bouncing all over the place. And so volatility increases the cost of caps just because there's more uncertainty, and it is essentially just a derivative instrument on your interest expense.
Makes perfect sense. Thank you so much for explaining that. It's funny. I was watching Patrick Carroll's Instagram story and LinkedIn post, and he made a very good point. And it was nothing salacious, but he made a very good point, which was about positive leverage and how he only wants to buy deals in positive leverage. But he made another comment because he was talking to one of his friends in the business, likely someone he did deals with in the past or just a thought leader, something of that nature. And what I found to be very interesting about his point is, the conversation is, kind of his tagline is, I want to invest when there's blood in the streets. But he mentioned that, I don't think there'll ever be a point where, debt was at, like 1% or so or 0% for a while. And you could buy, deals at, 4% cap rate where you had all this free cash flow. So his point is like, I don't think those fundamentals will ever be here today in a lot of the commercial real estate world. And I think so many people are just waiting and waiting and maybe waited too long to get into maybe perhaps the best time to invest, which is about 6, 8 months ago. But it was just the concept of buying on positive leverage and how crucial that was. And just for those, I'm going to say this one more time and explain this. What positive leverage is, that means your capitalization rate, your cap rate, as we call it, is exceeding your debt position, so your interest rate. So there needs to be a spread there to create positive leverage. So I found that to be very interesting that he doesn't think those days are going to come back. And I kind of generally tend to agree with it. I think the industry is a lot more institutionalized, which is great for liquidity purposes, but it probably means you are less likely to get really, really wild outsized returns. So all that's to say, what is your take on that comment? Because we're not getting positive leverage on really many opportunities now. Cap rates are going down. So, positive leverage, what's your kind of take on that conversation, and I guess getting creative here in the marketplace to create some alpha?
Yeah, so a couple pieces to that. I would say first off, you know, I think right now we what we've been seeing, and this really is a trickle down effect from big institutions and things, but where so many pension funds and institutions have had their, say they have a commercial real estate fund that has typically been, say, a piece to office, industrial, retail, multifamily, and say they got burned lately on, people have been getting burned on office, maybe their urban retail hasn't been doing well. And so a lot of those allocations that used to be towards, say, office are now getting cut because there's not really a path, there's not as rosy of a path forward to office. And so what's happening is, say, where you had, say, for example, there was an allocation of a fund that was mandated to be 25% multifamily, 25% office. Now that 25% office allocation is moving to multifamily. And so that the reason for that obviously is because, multifamily, I think everyone acknowledges, has in the US right now has incredibly strong fundamentals and is a safe bet. People are always going to need a place to live. I think everyone understands that there's a fundamental supply and demand imbalance in the US right now. And so it's perceived as a safer bet. And, in my opinion as well, I don't know that I would want to be investing in office right now. And so as a result of that, you know, the biggest influence on cap rates really is capital flows. And when there's a lot more of this institutional money flowing into multifamily and there's demand, it's compressing cap rates and making some of those deals more competitive. And I would say this is much more so on kind of class A institutional deals, but it trickles down throughout the whole market. And so, multifamily used to be maybe a little bit less uh, crowded, if you will, of a space. And so there maybe was a little bit less competition and easier to find positive leverage going in. Cap rates historically, the spread between cap rates in the 10-year, has historically compressed over time, and that's going to continue happening. But what I will say is, I think right now is a really compelling time to buy because we still can see, I would say, positive leverage on lots of deals, if not close to neutral leverage. And there are fewer deals that need to be purchased on negative leverage right now. And a large function of that is just, real estate cycles are slow. And as interest rates fall, just because interest rates come down 25 bips does not mean cap rates are going to come down 25 bips. It doesn't work like that. And so cap rates are going to fall slower than interest rates will. And as we, go into what we perceive as a cutting cycle, which should continue and rates come down, cap rates will compress, but interest rates are probably going to come down faster than cap rates, which is going to allow for some positive leverage and a strong spread, which is exactly why right now is such an attractive time to buy. And there still is a fair amount of capital that maybe has been shaken up, uh, that's not as interested in not looking to buy deals. And so that's really what it comes down to, and kind of how we see, how you, Rob, and I all see things right now, I think.
Yeah, without a doubt. So let's dive into the state of the market. Just maybe briefly summarize. I know you mentioned on some foreclosure topics and items there pertaining to the different submarkets that we're really predominantly looking to acquire in. But let's just talk about the state of the market from Texas, from the Houston, Dallas, and San Antonio market. However you want to start that, batting order and lineup. I'll let you figure out what leadoff hitter will go and let you take it away.
Yeah, definitely. So I guess to start off, we can start off with Houston, which has been, that's obviously where the majority of our portfolio is, and it's probably been our favorite market. And Houston feels like there's been actually a lot of activity over the past year, and I think a lot of that can be really attributed to Houston having very strong fundamentals right now. There, obviously, the supply story is very well known, nationally, across lots of markets. You hear about it in Texas. Um, and Houston right now, actually, in terms of their new inventory, is as a percentage of supply is actually below historical averages. And so we've seen positive rent growth in Houston right now, and expect that to only really increase as inventory falls off, and there's strong data showing that starts and deliveries are slowing down tremendously. So definitely very bullish on Houston right now. And then Dallas as
Well,
well.
real quick before we go to Dallas, Houston had the least amount of supply issues proportional to the number of units coming online to the units there, which is a very, very crucial and key metric to be thinking about here, which is your supply and demand ratios being, in a better place. So Houston has that. Houston is massive. It's the fourth biggest city in the country, and it just speaks to more and more how excited we are for being there. And I think we get probably the best looking deals in Houston from a fundamentals perspective. Is there any other little maybe key point or item you want to speak to? And it's not to say that San Antonio and Dallas aren't as solid, but can you maybe just talk about your love for Houston, and and why people, even if they've invested with us or capital raisers invested us, should kind of keep doubling down there, if you will?
Yeah, definitely. I mean, I think the as you said, it comes down to supply and demand. And supply, the supply story in Houston right now is very favorable, and it's in Houston also over the next 5 years is supposed to lead the country in population growth. And there's population growth and job growth. So people continue to move to Houston, and supply, there's not a huge threat of supply coming on right now. That and then kind of furthermore, I would also say Houston remains very affordable, which is important, and I think that's what will continue to drive growth, is because one of the key demand drivers in Houston, and why people continue to move there, is because it's affordable. You can, cost of living is, it's nowhere close to being somewhere like New York, that's for sure. And you can live a very comfortable life. I
Well, and
think,
also importantly too, it's like New York, though. It's the most diverse place in the country, which is very attractive for many people. many folks who are migrating to this country flock to Houston for many things, for many reasons. And obviously, there's a really core group and solid people of Houstonians who will never leave as well, despite it having some pretty oppressive weather. It's coming from a guy that lives in Phoenix, it's oppressive to me with the humidity, but it still has so many big draws. The jobs there are incredible. It has this kind of historical reputation of an oil and gas city, but it's so much more than that. The life sciences, the healthcare centers, the research there, the universities. Houston just has so much to offer.
Yeah, definitely. I think you really hit the nail on the head there. It's there's a lot to like, the and that is a very big point, I would say. It's Houston Houston is not nearly as energy dependent as it's made out to be, and that's used. It's a bit of a negative buzzword, if you will, but there's also a lot of innovation happening there, especially on the renewable fronts and things like that. And so it's not like Houston is just going to be a town fully tied to the price of oil. That's not what it is, and I feel like that's
Which,
a
by the way,
huge
for those who are
which
pocket,
yes,
yeah, for those who are pocket watching Houston right now in that respect, rest assured, price for bail is in fact going up right now. So more reason
yes,
to love Houston, though. As J.C. Clemens, our dear friend with Flagship Capital, said, when price of barrel is at $100 per, you'll have analysts at Eddie V's ordering seafood towers. One of the most all-time lines for the friend of the pod and company, JC. But now let's switch gears to Dallas, which you were getting there before I had to insert myself.
yeah. So Dallas as well, still very strong. I think we've touched on this, but even we saw rent growth even in the time period when we put Grand Riviera under contract to when we closed. Saw fundamentals improve and deals continue to perform well. I don't know don't have the exact supply figures on hand right now, but there still is a good amount of supply, but it's very submarket dependent and depends where you are um, in Dallas. But Dallas, obviously is the flashiest market, if you will. There's a tremendous amount of job growth there, tremendous diversity of jobs that just continues to flourish and is going to continue driving population growth. So, long term, Dallas is really, really an incredible market, and we're looking to expand there uh, definitely in the coming year, and are actively trying to find opportunities and want Dallas to be our Dallas portfolio to end up looking like our current Houston portfolio. Um, so yeah, I mean, I'd say the outlook in Dallas is strong. It's a more competitive market as a result of, I think, really, as I said, just the diversity of jobs and things. It's not coastal or anything, so that obviously attracts capital as well. But yeah, as a result, it's also more competitive. So it's going to be a focus of ours to find some opportunities there in the coming year.
Yeah, and I definitely think we want to, as you said it perfectly, we want our Houston portfolio to look like our Dallas, or our Dallas portfolio to look like our Houston portfolio. That said, it just can be very challenging because it is such a competitive market. It is, I would argue, if you were to pull 10 people through the country, what place, if you were to mention three markets you'd want to ideally invest in, if the profiles of deals and the returns were like for like or so, where would you want to find a good deal? I honestly think everyone would say Dallas is in their top three. I think unanimously it would be in the conversation for anyone. Now, someone might say Austin, someone might say Miami, someone might say Charleston or something of that nature. I'm not sure. But with that said, I definitely think that is something to consider and something to weigh is, yes, we love Dallas, but the numbers are just so tough to make it make sense without putting, getting more aggressive on our projections and our assumptions. So naturally, the person who wins the deal is the one who believes in the market and the opportunity the most. But we're going to have a more compressed IRR, internal rate of return, and equity multiple on the deal, typically speaking, in a Dallas deal due to that. But, there's also the nice downside protection as well to consider.
Definitely. Yeah. And it's a very strong market. It's very liquid, as you said. I think, yeah, your downside protection is very strong, and it's people feel comfortable investing there. It's why it'll continue to keep drawing more and more capital.
Yeah. So now let's go into good old San Antonio, where we officially bought our first deal there, uh, formerly known as Aspire, now known as Regency Grove. Let's talk about that market, and then maybe let's loop it into the wild card market, which we haven't discussed after, which I think has some mirroring and matching. But San Antonio, what is going on there? Pros, cons, the good, the bad, the ugly.
Yeah, definitely. So San Antonio, right now, similar to, I think this is what you're alluding to. Austin is, it definitely is dealing with lots of supply and has some short-term softness in fundamentals. There's lots of concessions and things, um, just as inventory continues to come online, and the, you know, supply is going to fall off in San Antonio very sharply in the future. In the coming years by 26 and things, I think it'll be in a very strong place, and you're going to get back to seeing some strong rent growth there. But it's short term, I would say, still are realistically seeing some negative rents are negative there right now, and it's it's definitely sub market specific, excuse me, but
And also
it's
property located specific too, right? Because I remember I was touring some properties
mhm.
earlier this year there, and the ones that were doing well were ones that were had, more core locations on the street, kind of just ABCs of real estate, location, location, location. Where is it located? Is there good signage? Is it easy for people to get to, their local hubs, from a bus stop or something of that nature? And the properties that were struggling were kind of off the beaten path. They were maybe and cut in or not, just not on the main road. So it's just kind of interesting how that is the case.
Yeah, yeah, definitely. And there hasn't been, frankly, a ton of product that's really what, fit our buy box. There are a lot of, smaller deals there. We really are trying to focus on 30 or $40 million deal size or larger, and, want greater scale in terms of unit size. And San Antonio just is naturally a smaller market, but there hasn't been a ton of that, just well located B plus assets that really we like to buy, that we've been able to transact on in San Antonio. So we have been tracking things, but there hasn't been as much as I would like to really take a run at. And obviously we certainly want to buy, and we want our San Antonio portfolio to be just as Dallas and Houston right now. And but in order to buy in San Antonio right now, it feels like there does need to be a little bit more of a discount than we're seeing on trades, just because short term you're still going to have short term fundamental issues, and it feels like I just lose you.
Can you hear me now?
Yeah, I got you back. Where'd you lose me?
Short term, we still have fundamental issues or short term.
Okay. Yeah. All right. So still have short term fundamental issues, and as a result, it's challenging because that we were talking about this a little bit earlier, but you've got to control your expense ratios and things, and your insurance is likely going to keep increasing, and it's your your payroll, all of the above. We're still seeing inflation. Your expenses are going to continue to increase, and it's hard to see NOI increasing in the near term to really keep up with that. and just frankly to make the numbers make sense, there has to be a more of a discount going in on price. And obviously, yes, we don't want to be scared just because there's some short-term softness. Obviously, this is when we want to buy. However, price is permanent, and if you can still overpay in a down market, and then you're not creating any alpha at all. And so
You're actually bailing someone out of a bad situation at that point.
exactly. And so that's a challenging part. It's all about the risk adjusted returns, as we say. And there's a price for everything, and we would love to buy in San Antonio, but it just feels like right now, it's been tough to transact there. We haven't seen as much deal flow as we'd like, and it's just tough to make the numbers work for us and for us to feel confident putting our money into a deal there.
Totally makes sense. Now, well, actually, real quick before we transition, you say fundamentals. Can you just explain maybe briefly what you mean by that? So we're not just throwing around some industry jargon and buzzwords to sound important and sophisticated.
Yeah, definitely. So just, I mean, really just comes down to supply. Supply and demand are obviously the big ones. Supply is the biggest issue right now, and as a result of all the supply, vacancy has taken a hit, and then properties are either having to decrease rents or offer concessions, which is effectively the same thing, um, no matter how you want to slice it. And vacancy right now, where usually San Antonio would be low 90s, um, you know, it's realistically right now maybe high 80s or so. It feels like 90. It's hard to underwrite a mid mid 90s occupancy on a deal right now. Just you've got to be realistic of where your operations can take you. You can be the greatest operator, but you can't control your surroundings. And so um, that's really what it comes down to, is just right now, short term, the demand just needs to keep up and keep growing so that we start seeing some stronger absorption numbers and really get back to a more favorable supply and demand balance.
Fair play. Thank you so much for the breakdown. Real quick, let's talk about a market that is, maybe you could argue it's like the guy or girl that is so attractive. It's got so many great things going on. They can be great, but there's just some red flags. There's just some things that just don't quite pencil out. There's just some hesitations you've got going on. Maybe it's like, hey, the juice is not worth the squeeze. This person's a little high maintenance. And that market is, in fact, Austin, Texas. Let's get into it. Do we like it? Do we not like it? Will we be there at some point? What is your take?
So first of all, I have to preface this. We're not actively looking in Austin. I'm not going to tout myself and as an expert of the Austin market, but however, from what I have seen, um, it's it's still just it still is challenging for us, at least in the near term. They Austin is, obviously has seen a tremendous amount of growth and has really blown up over the past, 10 years or so. And the biggest issue is obviously there was so much demand and so much hype for Austin, a tremendous amount of rent growth, and then as a result, an insane amount of supply. And right now, Austin, which is, mind you, a much, much smaller market than DFW, has about as much supply coming online as all of DFW, which is really, really scary. And so,
And
on
might
lot,
I add, 10,000 units more than Houston, which is, maybe equivalent to DFW size. I mean, Dallas Fort Worth is a little bit loaded because they're considering it not one metroplex in city. So it's not one submarket per se. There's Dallas and there's Fort Worth. But doesn't Austin have 50,000 units coming online or was being built, which is about 15% of the total unit count?
Something like that. I don't have, unfortunately, I don't have all these numbers off the top of my head. I probably should, but
Long
yes,
story long, it is
it's
it's not good. It's not good if you're an investor. It's not good. Let's just call it what it is. It's a problem.
no. And so, yeah, I mean, just what it comes down to, you've got, lots of these properties are there's all this new supply. The supply needs to be leased up. So they're offering, 2 months of concessions per se, and the concessions are going to continue because there's just more and more supply that continues to come. And however, that will be short term. Austin will work itself out in the long run. However, over the next few years, to me, it's just very, very challenging to see how you can buy those deals, in call it for a low five cap or so. It's it doesn't make sense to me. You uh, certainly, I would not, if I was buying that deal, I would not want to buy that with any debt on the property. That would scare me for sure. Um, and it's challenging. I think, a lot of the product there as well is naturally much newer and will just be more institutional. It's, as you said, kind of it's the sexier market, and people want to be in Austin because the demand story is so strong, and it's really easy to get caught up in demand and lose track of supply for lots of investors. But, it ultimately comes down to relative value and where we feel like we can find alpha in the markets. And right now, there's just not enough that's getting us excited for Austin in the near term. It could make sense long term, maybe if we can find some more affordable strategies and things in Austin, that could definitely pique our interest and draw us into the market. But for now, we've got more than enough to deal with in Houston, Dallas, and San Antonio. So I think that's where our focus will remain. Um, and yes, again, I'm no expert on Austin, so I understand the fundamentals high level and hear things through the grapevine from brokers of how deals are trading there. So, not calling myself an expert, but there's not enough to get us off the sidelines to get into Austin right now.
Well, thank you for the market breakdown there on the core and target locations we're seeking. Let's get into value add plays. I think I teased this before. I've talked about it with Rob, but I also want to just have this discussion here, which is so many people have this mindset or probably read a book or two or three or eight about how investing in real estate is so awesome. Maybe this book was published a decade ago, 2 decades ago, 5 years ago, about value add, value add, value add, and that's the only way to make money in real estate. But it's not really so. And I think the core reason I'm bringing this up, the genesis to this thought, that the crux of the matter is the following: it's that you've got to get paid for your dollars. There's got to be a return of cost, and value add deals, few and far between, are really not making sense. We've only done, I want to say, maybe one or two value add, like true down the fairway value add plays in the last 2 years, maybe since year 10 year in mind, 2-3 years. Not very much when you look at how much we've scaled up. We've been able to buy and achieve good returns elsewhere and think there's better value elsewhere. But can you maybe just harp on that kind of sentiment and thought, or disagree with me if you see fit?
Yeah, so I think you bring up a very good point, and that it's value add comes down to getting paid for the work you're doing. And ultimately, whether it's a strong market or softer market, and by that, you know, what I mean is if there's, softer rent growth or stronger rent growth, it shouldn't that shouldn't necessarily heavily determine your value add strategy, because you're coming in to do renovations and execute a value add plan based on based on the story, say there are, a comp driven story, say property across the street is getting these bumps and there's clear demand, then, and they're getting $200 for putting in granite and quartz, or not granite and quartz, granite and stainless appliances, um, then it makes sense. However, if even if you're in a hot market, I don't necessarily think that means that is especially a time to do value add, because your units, you're still going to experience rent growth, and there still will be rent growth to be had. However, you could have a bad value add plan when there's strong rent growth, and maybe you'll look good to your investors because they're seeing that rents are increasing as you're doing renovations. However, it could still net out to being a less than favorable ROI, because maybe you didn't need to actually spend that money to get an extra pop, and you're seeing enough rent growth without spending the dollars to invest in improving a unit. And so I think that's going to be it's going to be very interesting to see kind of in this next cycle, and as rent growth does pick up, what happens, and how operators approach and value, really kind of older assets that typically have been stronger value add plays. Because I think we've certainly learned a lot from this cycle as well, and have tracked and seen what we've done and what other operators have done. And I think it all comes down to just the specific property and the story. There's not really I would never strongly support value add or strongly argue against it, just as a blanket statement. I think it really just comes down to each situation and each deal story.
Fair enough. Well, Brad, we could talk forever. I think that much is clear. We should probably end it now before we go any longer and get ourselves in trouble here. Thank you so much for coming on. I would say where can we find you, but it's very clear. It's LinkedIn. Email him if you have any questions. It's brad@lscre.com. Is that correct?
Correct.
Awesome. Everyone for being here, thank you so much. If you have any questions as well that you think would be important, if you've made it this far, that you'd like Brad to answer or us to talk about, maybe in the next episode, Brad will likely come on the flagship podcast with Rob and I soon. Get those questions over to myself and Brad. If you have any, we'd love to connect with you. Brad, thank you so much. And everyone who's listened, thank you so much. And we'll see you next week. Peace.
Thanks for having me on.